Welcome back to Corporate Finance. Last time we applied our forecast drivers to our free cash flow formula to forecast free cash flows for our tablet project. Today, I want to take those free cash flows and apply our different decision criteria to come up with decisions regarding our project. Let's get started. Hi everyone, welcome back to Corporate Finance. Today we're going to talk about decision criteria, but before doing so, let's recap our previous lecture in which we forecasted free cash flows. Specifically, we took our forecast drivers, our assumptions about what would happen in the future, and applied them to generate dollar forecasts of all of the components of the free cash flow formula, which we then built up, aggregated into free cash flow forecasts. Today we're going to turn to what to do with those forecasts by looking at different decision criteria. So let's get started. So what do we do with our cash flows from last time? One thing we can do is we can compute the NPV. And I'm going to assume a discount rate of 12%, that is R equals 12%. And if we do that and apply it to our free cash flows that we computed in the last lecture, what we're going to see is that this project, this tablet project, has an NPV of $708.42 million. Not bad. What that means is that firm value, debt plus equity, is going to increase by $708.42 million in expectation if the project is undertaken. So from a decision-making standpoint, undertake the project. That's what the NPV rule tells us. It says accept all projects with a positive NPV, reject all projects with a negative NPV. And while this has boiled it down to one number, I want to be careful, especially when we start doing our sensitivity analysis, to recognize that we don't want to pin all our hopes to that one number. Now, another thing we can do is we can compute the internal rate of return. The internal rate of return of a project, recall, is the one discount rate such that the net present value of the project's free cash flows equals 0. We've actually already seen this when we were talking about yields. Remember, the yield is the one discount rate such that when you discount the cash flows by the yield, you get the price. But the NPV is nothing more than the price minus the present value of all the future cash flows. Okay? So IRR and yield are really one and the same. So what's the IRR for this project? Well, we write our NPV formula, we set our NPV equal to 0, and then we solve for the one discount rate such that when we discount all of our free cash flows, we get an NPV of 0. If we do that, we find that the IRR on this project is 43.7%. Well, is that good? Is it bad? Before getting there, I just want to mention, typically we're going to need to solve this numerically unless you have figured out some amazing way to solve higher order polynomials. You can use the IRR function in Excel. I think you can use goal-seek in Excel. You can try trial and error, though that's really inefficient. If you're using another software program or a financial calculator, you can do this as well. Okay. All right. So what do we do with this 43.7% IRR? Well, we're going to compare it to our cost of capital, our hurdle rate. And what we're going to do is we're going to undertake the project because the IRR is greater than the hurdle rate. Intuitively, it makes sense. And this is one of those cases where intuition actually works. It costs us 12% to raise money in the capital markets, to fund our investments, to create value. If this project generates a return of 43.7%, that's substantially larger than what it cost us to raise the funds. That sounds good. That makes sense. And so what the IRR rule says is accept all projects whose IRR is greater than R, and reject all projects whose IRR is less than R, where R is our hurdle rate. Hurdle rate, cost of capital, our discount rate. Now, I do want to mention that the IRR rule is informative. It's also somewhat intuitive and appeals a lot to investors who tend to think in terms of returns, but it's got a number of shortcomings that we're going to explore in greater detail in topic 4, return on investment. Now, one picture I'd like to show you is the following. I've plotted the cost of capital on the horizontal axis and the project NPV on the vertical axis. And what the blue line shows is it shows how the NPV of the project varies as I vary the cost of capital. 2 points are worth noting. First is this point right here, which is the 12% cost of capital of the project, you'll notice that generates an NPV, as we saw earlier, of a little bit over $700 million. The second point I want to point out is this point, the point where the graph crosses the x-axis. That's the point at which the NPV is 0, which, as we know from our definition earlier, is just the IRR. That's 43.7%. Now, I think this graph is, let me clear this up a little bit, this graph is useful because from a sensitivity analysis or a robustness perspective. Look, this R is an estimate, and to be honest with you, it's typically a noisy one. What I see here is I see a really wide gap between my estimated cost of capital and the point at which this project just breaks even. So even if we disagree on the cost of capital and you're taking a more conservative view and you think it's up, or our real cost of capital is 20%, that's okay. This project is still NPV positive. It's still value accretive. And so what this gap here shows is it shows that I've got a lot of room for error, at least on the discount rate dimension. The third thing we can do with our cash flows, our free cash flows, is compute a payback period, which is the duration or the time until the cumulative free cash flows turn positive. So let's look at our project. Here are our free cash flows. I'm going to accumulate them year over year. So this negative 510.4 is just the 376.8 in year 0 plus the negative 133.6 in year 1, and on for years 2 through 5. And then I'm going to look at the cumulative free cash flows and ask, when do they turn positive? Well, they turn positive right here in year 3. So our payback period is year 3. We turn cash flow positive in year 3. Some people might say it takes 3 years to recover your investment. Is that good? Is it bad? How do we know if 3 is good? How does that help us in our decision of whether or not to undertake the project? Well, what we do is we compare it to some threshold. And so the payback period rule says accept all projects with a payback period less than the threshold, reject all projects with payback periods greater than that threshold. But it should be immediately clear that the payback rule, or the payback period rule, has several shortcomings, the first of which is it's ignoring the time value of money and risk of cash flows. The first sin that we learned way back at the start of the course. But fortunately, that's actually quite easy to deal with. We can compute the discounted payback period by discounting the free cash flows, right? The discounted payback period of a project is just the duration until the cumulative discounted free cash flows turn positive. And so on this slide, I computed those discounted free cash flows using our cost of capital of 12%. And then I accumulate them and wait, or count until they turn positive, which is right here in year 4. So our discounted payback period is 4, which is greater than our payback period of 3. But even using the discounted payback period, this rule has a number of shortcomings. For example, it ignores cash flows after the cutoff, and that's going to lead to myopic decision making. Let me go back a slide. What if this cash flow in year 5 was $20 billion? Well, $20,114 million. It'd be a shame, to ignore that and the implication for that, of that cash flow. So by ignoring those cash flows, you get myopic decision making. Number 2, it's not telling us the value implications of our decision, right? It's not helping us quantify the effects of any decision that we make. It's also not helpful in choosing among projects with similar payback periods. So I've got 3 projects. They all have payback periods of 4. Which one do I choose if I can only choose one? All right, so let's bring this all back together. Let's bring it full circle. So there's several decision criteria. NPV is unambiguously the best and should always be used. But I want to emphasize that others, such as the internal rate of return and payback period, or its discounted cousin, they're all informative. And the key is to understand the shortcomings of these alternative decision criteria to avoid any mistakes that feed into the ultimate decision. So what I want to turn to in our next class is sensitivity analysis, which is an integral component of any DCF. Thanks again, and I look forward to seeing you. Welcome back to Corporate Finance. Last time, we applied our different decision criteria to our forecasted free cash flows to come up with a decision as to what to do with our tablet project. This time, I want to push those assumptions around, the forecast drivers and other assumptions, to see how robust our decision is in a process called sensitivity analysis. Let's get started. Hey everyone, welcome back to Corporate Finance. Today we're going to be talking about decision criteria, but as always, let's start with a recap of our last lecture. So last time we talked about decision criteria. In particular, we asked, what do we do with our free cash flow? And there were several things we could do. We could compute an NPV, we could compute an IRR, or we could compute a payback period. And we talked about how to implement those decision criteria and what decision to make, and we also alluded to some of the shortcomings of those decision criteria. Today I want to turn to sensitivity analysis. In other words, having set up our DCF and having completed all the inputs, now let's push it around a little bit and just see how robust and sensitive our valuation is so we can make the most informed decision possible. So let's get started. And we're going to start with something called break-even analysis. Break-even analysis finds the parameter value that sets the NPV of the project equal to 0, holding fixed all other parameters. So let's look at our cost of capital and an initial investment forecast drivers. Right? And I've got base up here to represent a base case. We're going to look at alternative cases in just a minute. You can see our base case assumption for the cost of capital was 12%, just a little over 12%, and our initial investment was $227.7 million. The corresponding NPVs for those assumptions were 708.42. Right? It's the same. It's the base case. Okay, that's what we computed in our previous lectures. Okay. The break-even values, in other words, the value for the cost of capital such that the NPV right here is 0 is 43.72. But that should look familiar because the break-even point for the cost of capital is nothing more than the IRR. Okay. And as we discussed in the last lecture on decision criteria, you can see there's a lot of room here before this project looks bad, at least on the cost of capital dimension. For the initial investment, our initial investment would have to be closer to $1 billion before this project started to turn negative. All right. Now, how did I get these? Well, I just used GoalSeek. What I did is I set the NPV cell, for example, this cell, to 0, and I would change the input parameter. And GoalSeek goes around by iterating it to find the 0 value. Now, I did this for all of our inputs, and I can only show you a subset. Otherwise, things get ridiculously small. It doesn't fit well on the screen. But what I like to do when looking at the break-even estimates is gauge how much room I have, at least in a partial equilibrium notion, because remember, I'm only changing one parameter at a time, and I'm going to emphasize that again in a second. I'm going to look at how much breathing room I have until the project turns south or becomes negative NPV. And so you can see these purple arrows identify parameters for which there seems to be a fair amount of scope for error, or a large margin for error. Right? So take a look at the PPE liquidation value here. I'm assuming I'm getting 50 cents on the dollar when I liquidate all of my plant and equipment at the end of the 5 years. It would take a loss of 2,253% before this thing turned negative NPV. I'd have to be dealing with some kind of maybe nuclear waste, right? Something like that. But that's not the case here. Similarly, the initial unit price, unless we're going to price this thing at $77, just over $77 per unit, this thing is positive. This project is positive NPV. This is in contrast to some of the parameters for which there doesn't seem to be quite as much a margin for error, right? So if I look at my initial market size, I'm looking to the initial market size of 1 million units. But if there's not a lot of enthusiasm, say only a little over half a million, this project becomes NPV negative. Again, holding all other parameters constant. So this break-even analysis, I think, is a useful tool for gauging how much room we have one dimension at a time before the project becomes value destructive. Okay. And I want to emphasize that this is a partial equilibrium analysis. It assumes the parameters are independent, right? I'm changing one parameter at a time, and in some cases that's an unreasonable assumption. It's not to say the break-even analysis is uninformative. It's just that we have to recognize the limitation of that analysis. Now let's turn to some comparative statics. And comparative statics are going to quantify the sensitivity of the valuation to variation in a parameter holding fixed all other parameters. So what I'm going to do is I want to look at how does valuation change parameter variation from what I'll call a worst case to a best case scenario for each parameter. And again, I'm going to focus on the cost of capital and the initial investment. And by my estimates in discussion with Treasury, right, the sort of range of estimates for my cost of capital vary from a low of 9.61, which is a best case scenario, right, very inexpensive cost of capital, to a high of 15.01%. Likewise, my ops people tell me that the initial investment is likely to be $227 million, but it could go as high as 284. It could go as low as 185, depending upon short-term variation in materials and labor, etc. Okay. Right. What I see underneath each parameter estimate is the corresponding NPV. So when I change the cost of capital to 15.01%, the NPV of the project is $594 million. When I increase the cost of the initial investment from 227 to 284, right, the NPV moves from 708, our base case, to 649.47. Okay. So I actually like to look at this table. One is to get some sense of the sensitivity of the valuation to specific to changes in specific parameters. But I also like to use it as a gut check, a reality check, to make sure that the valuation varies sensibly with variation in the parameters. If I had found that as I increased the cost of capital, that the valuation here, the numbers actually went up, I've got an error somewhere in my model. Right? Okay. So how did I get this? I just used an Excel data table. Right? So these are inputs right here. Right? So all you do is highlight the matrix. Right? The NPV of the project is here in the bottom left. The parameters are in the top row. And you choose a row input cell and enter the parameter cell. That's it. Nothing more than a data table. Okay? And I did this for all of the parameters, though I don't show you all the parameters here, and it's just useful to move through them to make sure things make sense. So if I look at initial market share, for example, right here, what I see is a worst case scenario of 15%, or our penetration is only 15%, versus an initial penetration of 35, an initial penetration of 35 in a best case scenario, and you can see that the valuations increase with our penetration, which makes sense. We're selling more units. And notice they actually increase by a lot. We're going to see that that's an important value driver. So what is the elasticity of the valuation with respect to each parameter? So it's similar to what we did, but it puts a little bit more structure on the changes in the parameter, so we can compare the sensitivity of the valuation to different parameters a little bit more sensibly. So what is the elasticity? Well, it's just defined as the percentage change in the NPV divided by the percentage change in the parameter. Or delta, remember this is nothing more than change. The change in the NPV divided by the change in the parameter times the ratio of the parameter to the NPV. Okay. Let's look at an example. Here's my cost of capital. Okay. What I've done is I've computed a cost of capital that is 1% higher and 1% lower. And I've computed the corresponding NPVs. So to estimate the elasticity of the NPV with respect to the cost of capital, I've simply looked at the delta yellow. Get rid of that guy. Delta NPV over delta parameter, delta in the cost of capital. Okay. So I've taken this guy, 703.53 minus the 713.34. Okay. And I've divided that by the difference of 12.13 minus 11.89. Then I multiply that times the average of the two numbers. So this is really just the average of the parameter values. This is the average of the NPVs. And obviously these halves cancel one another, but I wanted to put them there to emphasize that I'm just taking the average of these 2 points. And the reason I'm doing this is because the elasticity will vary depending upon the direction in which we calculate it. Not by much, but by a little. So this is just this is one possibility or one approach for computing it. And the elasticity I get is minus 0.69, right? So a 1% increase in the cost of capital, a 1% relative increase, I should add, in the cost of capital is associated with a 0.69% decrease in the NPV of the project. And I can do that for all of the parameters. Again, I'm just showing you a few, but you can see a couple parameters start popping out very quickly, such as the initial market size, our assumption on the market growth rate, right? Our initial market share, our assumption on cost of goods sold, right? These, again, are going to correspond pretty closely to what we saw with our break-even analysis, and they're really identifying the key value drivers, the things we should really be focused on when discussing this project. But again, like our previous analysis, break-even, and our little scenario analyses, well, not scenario, sorry, our comparative statics. Comparative statics implicitly assume parameters are independent of one another. We're varying one parameter at a time, and sometimes that just doesn't make sense. So that's going to lead us to scenario analysis. What scenario analysis is going to do is it's going to quantify the sensitivity of the valuation to variation along multiple dimensions. We can vary multiple parameters. So what I've done here, going back to that best and worst case scenario, is I've said, what's the worst case scenario for all the parameters here? And the best case scenario for all the parameters. Now that's not necessarily the optimal thing to do, but it's illustrative. You might want to say, what's sort of the worst case scenario if the economy goes south? Right? How's that going to affect each parameter? It may not be the worst case for each scenario, for each parameter individually, but jointly it might correspond to some sort of bad economic state of the world. Having said that, I've computed I've set up each of these scenarios, worst, best, base, and best, okay? And I've just done a little scenario analysis. And what I find is that in the worst case scenario, this project is, over half a billion dollars negative NPV. The best case scenario is 33 billion positive NPV and relative to our base scenario. Now I wouldn't read too much into those numbers, again, because I've taken the worst case scenario for each parameter independently, and that doesn't make a lot of sense. Again, what you want to do when you're constructing these best and worst case scenarios is think, okay, let's think about a bad economic state of the world where maybe not everything goes horrible in the project, but where some things go bad and maybe other things are good. So if it's a bad state of the world, maybe labor costs go down, right? And it becomes cheaper to build the plant. You want to think about these things and how parameters are related and what really represents a plausible best and worst case scenario. Now, how did I do this? I just used scenarios in Excel. That's one way to do it. That's how I initially did it. But that's actually really inefficient. A much better way is to set up a lookup table and a toggle that you can just switch all the parameters between. Much more efficient. So here's a question. What else can we do with sensitivity analysis? We can answer some important questions that are going to come up in discussions. Here's one, for example. Imagine strategy wants to reduce the price by $30 in order to increase the initial market penetration from 25% to 30% by their estimates. Does this make sense? Well, we can answer that question. In this table, what I've done is I've set up a little two-way table. I've got quantity, our initial market share right here, our initial penetration, and price here. So these are all prices. Here are all my market shares. Here's our base case scenario in which we're assuming 25% initial market share at a unit price of $200. And marketing's asking what's going to happen if we change these. Well, in particular, they want to lower the price by $30 from $200 to $170. And they argue that's going to increase our market share upwards of, say, 30%. Well, what does that mean from a valuation perspective? Well, if we look in this box right here, we see that the NPV is going to be somewhere between $776 million and $851 million. So what's the answer to the original question? It's a good thing, right? NPV is going to go up relative to our base. Here was our base. Marketing says drop the price. That increases penetration. And sure enough, valuations go up. So it sounds like a sensible thing to do. Okay. Marketing, on the other hand, is concerned about uncertainty surrounding the market for tablets and wants to understand if we can shed any light on that. Can we provide some information? So here's another two-way table. I've got market growth rates here. Right, market growth rates there. I've got market size assumptions here, initial market size. Okay. Right? Here's our base case indicated by the black outline boxes. So the initial market size was going to be 1 million units, and we were assuming 2,500% growth in that next year. Okay. But what this picture shows is it shows that as that growth varies and as that market size vary, what happens to the valuation? The cells inside are NPVs. And I've color-coded them so that green is at or better than our baseline, right? You can see our baseline is all along. I've held the baseline constant along the diagonal here, all 70842. Yellow is positive NPV, but worse or below the base case NPV, and red is negative NPV. And so this provides some picture of how much slack we have, at least along the initial market size and market growth rate assumptions. Finally, I want to talk about simulation analysis. Okay. Simulation analysis, we're going to perform the valuation for a large number of scenarios, a whole bunch of different parameter values. And what I did is I selected 500 different scenarios. What I did is I just randomly drew parameter values from a distribution constrained by the best and worst case scenario for each parameter. And I did that 500 times. And I computed the NPV for all 500 draws. And I plotted them here in a histogram. Right? So I have here the NPV along the horizontal axis, and the y-axis is the fraction of the 500 simulated scenarios corresponding to each NPV. And this red dashed line is the 0 NPV value. And what you can see up here is 77.78% of the simulations are positive NPV, 22.2% are negative NPV. And so the takeaway is it looks like a pretty good bet. This project looks like a pretty good bet, conditional on all of the assumptions that we've made to get there. We've been able to push it around through a host of different scenarios, and this thing tends to be a positive NPV project, value accretive. Okay. That said, I want to emphasize that the parameters were drawn independently of one another, and that's not ideal. It's going to lead to some implausible outcomes, and it's not a particularly reasonable assumption, especially when it comes to certain parameter pairs, such as price and quantity. That's just one. Ideally, you want to draw from some large multivariate distribution, but now we're moving way outside the scope of this course into a valuation exercise. What I want to do is instead emphasize the importance of simulation analysis, even small-scale simulation analysis. Say you just laid out by hand, 10, 15 different scenarios. Computing power is cheap. Compute the NPV and just look at how those NPVs look across the different scenarios. All right, so let's summarize this and bring it all back together. I really want to emphasize that no DCF is complete without a sensitivity analysis. It's really an integral component of any valuation, any sort of capital budgeting or broader valuation, I should say. It's going to help us identify where value is created or destroyed. It's going to identify the key value drivers where we should really focus our time and effort in terms of our discussions for making the decision. It's also going to help us quantify and assess our risk exposure. How much can we lose? How frequently can we lose it? And it's going to help us understand the robustness of the profitability of the project. So next time, we're going to turn to a new topic, return on investment, which is actually closely related to our decision criteria. We're really going to hone in on IRR and look at some of its strengths and weaknesses. So thanks again for listening, and I look forward to seeing you in the next lecture. Welcome back to Corporate Finance. Today, we're going to turn to a new topic, return on investment. But before doing so, I want to briefly recap our last topic, discounted cash flow analysis. If you'll recall, we started off with a discussion of how firms, or people more generally, should be making decisions through different decision criteria. Then we talked about free cash flow, at least from a conceptual standpoint. We then discussed forecast drivers, or the assumptions required to forecast free cash flows into the future. If you'll remember, we did that in the context of a tablet. We then applied our assumptions, our forecast drivers, to our free cash flow formula to get forecasts of free cash flows for our tablet project. We then brought our decision criteria back in and applied it to the forecasted free cash flows to come to a decision of whether or not to proceed with our tablet project. And we closed out the topic with a discussion of sensitivity analysis to investigate just how robust our assumptions and decisions are. Today, I want to talk about return on investment. And in particular, what I want to discuss is the strengths and weaknesses of the internal rate of return relative to the net present value rule. So let's get started. Hey everybody, welcome back to Corporate Finance. Today we're turning to a new topic, return on investment. But before diving in, I actually want to spend a little bit of time recapping our last topic, discounted cash flow analysis. So what we did in our DCF topic is we began by introducing decision making. We showed some evidence, looked at some survey evidence of what people in practice were doing, CFOs of non-financial companies, private equity managers, and investment bankers. And we showed that they used a number of different criteria, DCF or NPV, IRR, and payback period. Then we turned to looking at free cash flow, one of the key components of any DCF. And we talked about the components that make up free cash flow and how to aggregate them. Then we talked about forecast drivers, or the assumptions necessary to forecast each of the components of free cash flow. And we did it in the context of a capital budgeting example of a tablet. We then applied our forecast drivers to forecast out each component of free cash flow and aggregate up to get a free cash flow projection. We then looked at different decision criteria. That is, we figured out what to do with those cash flows and ultimately what decision to make regarding the tablet. Specifically, we looked at NPV, IRR, and payback period. We talked about their strengths, some of their weaknesses, and then we closed out the topic with a discussion of sensitivity analysis, an integral element of any DCF. Now I really want to continue on the theme set by DCF and talk about return on an investment and really emphasize IRR versus NPV, the two most commonly used decision metrics. So let's get started. So recall that the internal rate of return of an asset is the one discount rate such that the NPV of the asset's free cash flows equals 0. So I have NPV, I have cash flow, we could have free cash flow. Don't let the convention confuse you. IRR is much broader than just free cash flow, as is cash flow. But anyway, IRR is just that one discount rate such that the NPV is equal to 0. The IRR decision rule, as you might recall, says accept all projects for which the IRR is greater than R, reject all projects for which the IRR is less than R, where R is our hurdle rate or opportunity cost of capital. Opportunity cost of capital. Okay. And the intuition was simple. If it's costing us R% to raise money to fund investment, that investment should return something at least as big, if not greater than R. Preferably greater. Okay. Now, I'm going to spend some time here talking about IRR, a little bit of motivation here, because rates of return are really popular measures used for making decisions. Remember back to the survey evidence, internal rate of return was the most popular decision criteria used by CFOs. It just edged out NPV, right? And likewise, for PE firms, private equity firms, internal rate of return is by far the dominant decision criterion used for evaluating investments. So it's really important to understand this criterion. So let's compare it to NPV, and let's do it by way of an example, shortly, I should say. So first, the IRR is going to lead to the same decision, accept or reject, as the NPV rule if all negative cash flows precede all positive cash flows. So here are some examples of cash flow sequences, at least the sign of the cash flows, where the IRR and NPV rules will coincide, right? So I pay a bunch of money today, and then I get nothing but positive cash flows. I pay money for the first 3 years, right? I don't like that. Let's do this. For year 1, 2, and 3, and then years 4, 5, and on are all positive. The key is that the negatives have to come before the positives. Negative before positive. Then IRR and NPV lead to the same decision. Okay? If that pattern of cash flow signs is violated, not only may IRR and NPV rules not coincide, not lead to the same decision, but you can get some pretty wacky stuff with IRR, from multiple IRRs, in which case, which one do you choose? It's not obvious, to imaginary IRRs. and I mean mathematically imaginary IRRs. You'll get an IRR times some number times the square root of -1, which is really hard to convey to a CEO. Trust me. So let's think about whether or not we can compare projects using IRR. And here's where I want to work in the context of a specific example. Imagine Wharton wants to upgrade its IT system and overhaul its network infrastructure. So it puts out a request for proposals, an RFP, and in comes a bid from Cisco. And the Cisco bid, we evaluate to generate $60 million in cost savings over 3 years for an upfront cost to Wharton of $100 million. Now, if our cost of capital, Wharton's cost of capital is 12%, what is our assessment of this bid? Okay. First things first, write down the cash flows. Here they are. We're going to get, right, bid 1. It's going to cost us $100 million today, then we're going to experience cost savings of $60 million for the next 3 years. Okay. We can compute, let's clear this up. We can compute the IRR by solving this equation, right? Just set the NPV for the project equal to 0 and solve for IRR. That gets us 36%. Now, because the IRR is greater than the discount rate, our hurdle rate, remember, that was 12%, and the cash flow signs are proper, that is, they follow, right, negatives followed by positives, this project looks good. Okay. If we compute the NPV, if we just discount the cash flows, future cash flows by the Wharton's cost of capital, 12%, we're going to get an NPV of $44.11 million, which is greater than 0. Well, that looks good too. So both IRR and NPV point in the same direction. This looks like a reasonable bid. Wharton's going to be better off by accepting it. Okay. But then Cisco comes back and they say, we're going to give you the same cost savings, $60 million over 3 years. But now what we're going to do, instead of charging you $100 million up front, we're going to spread the costs over time. $20 million today and then $35 million over 3 years. So let's try evaluating this bid. I mean, it sounds somewhat attractive if we can avoid that huge upfront bill. So for bid 1A, here are the costs. It's going to cost us $20 million up front as opposed to $100 million, but we're going to have to pay $35 million over the next 3 years. Okay. We still get the same cost savings, so the net cash flows for this bid are minus 20, 25, 25, and 25. Okay. let's compute the IRR and NPV. IRR first. Well, the IRR, we set the NPV of these cash flows equal to 0, solve for the IRR, and we get, whoa, 112%. That's impressive. That is very impressive. And we see that the IRR for bid 1A, this bid, is 112% is greater, much greater. I'm going to put much greater than the bid 1, the first bid from Cisco, which had an IRR of 36%. We can also compute the NPV by just discounting by the cost of capital, 12%, Wharton's cost of capital. That gets us an NPV of $40.05 million. So bid 1 had an NPV of 44.11 million. Bid 1A has a NPV of 40.05 million, which according to the NPV rule means bid 1 is better than bid 1A. What's going on here, right? NPV says bid 1 is better, right? 44.1 is bigger than the 40.05. IRR says bid 1A is better because the 112% return is better than 36% return. What do? Well, let's take a closer look. That's the first thing we do. And we see, let's look. Here's bid 1. Cisco's costs are $100 million, all up front. For bid 1A, sorry, Cisco's costs. Wharton's costs are $100 million up front. Bid 1A, Wharton's costs are only $20 million up front, but then $35 million every year thereafter. And so what bid 1A is doing is it's inserting a loan. Cisco's lending us money, right? In particular, they're lending us $80 million today in exchange for $35 million over the next 3 years. Here's a question. What's the interest rate on the loan? We can figure that out, right? I can figure out what the interest rate on this loan is. How? Just compute the IRR, right? Just compute the IRR. And if we do that, we see that the interest rate is 15%. Right? And again, this is just the IRR. I want to emphasize that. Let me clean that up. It doesn't look, right, if I move this over here, this will be 0, this will and this will equal, oops, having trouble, equals minus 80, right? Okay, so that is just the IRR. It's 15%. It's also the yield to maturity, okay, which we've discussed in the past. Well, is the 15% high or low? Is it good or bad? Well, it's terrible. Cisco's charging us a higher interest rate than our cost of capital. In other words, we can go to the capital markets and raise the money for a loan at 12% as opposed to implicitly borrow from Cisco at 15%. Right? See, what happened is the IRR increased because the initial investment fell more than the future cash flows. Right? Small payoffs on a really small investment can generate very large returns. We're dividing by small numbers here. Okay? See, but the NPV rightfully fell because Cisco's lending us money at an interest rate that's greater than our cost of capital. So the IRR spiked because we have this smaller upfront investment. That's very misleading. The NPV fell. It accurately captured the bad loan Cisco was inserting into the deal. And so the lesson here is that IRR projects can mislead when we're deciding among projects, whereas NPV will not mislead in comparisons. The larger the NPV, the greater the value. Now, let's briefly talk about a couple of additional bids, just to hammer home the point. We also heard from Juniper and Huawei, who had costs and cost savings for us as laid out in this table. And how would we rank these bids according to the IRR and NPV? Well, we know how to compute the IRR and NPV. We just replicate or repeat what we did for Cisco or what we've done in past lectures. And you can get this set of IRRs and this set of NPVs. And what you quickly see is that the IRR ranking is that the Huawei number 3 bid is better than the number 2 bid from Juniper, which is better than the number 1 bid from Cisco. The exact opposite ranking relative to what NPV tells us. Okay. And here's a picture of what's going on. I've got the discount rate. We've seen a picture like this before. I've got the discount rate on the horizontal axis, and I've got NPV on the vertical axis. And each line graphs the relation between NPV as a function of the discount rate. So at our cost of capital here, if we go up to each line, we can see the NPVs of each of the bids. And quite clearly, the Cisco bid on the green line is better than the Juniper bid on the red line, which is better than the Huawei bid, which is on the blue line. When we go over here where the lines cross the x-axis, right, these are the IRRs, right? By definition, the IRR is the discount rate where the NPV equals 0. Here are the Here are the IRRs. In this case, we see that the IRR for Huawei is much bigger than the IRR for Juniper, which is bigger than the IRR for Cisco. Okay? The exact opposite ranking according to the IRR rule, or relative to the NPV rule. What's going on? Well, if you look more closely at the cash flow streams, you can see that Huawei has small upfront costs. That increases the IRR, relatively speaking. And Juniper has front-loaded cash flows, which is going to increase the IRR relative to the Cisco bid. So one lesson is the IRR does not address differences in scale. And there's no better way to emphasize this point than to ask, would you rather earn 100% on a $1 investment or 10% on $1 million of investment? Well, quite clearly the latter. You're going to wind up with a lot more money. Okay? Some more intuition. Juniper's bid is actually like Cisco's with an embedded loan. Right? And you can see that here, where Cisco charges $100 million, then you get the cost savings. What Huawei is doing is it's giving you an $80 million loan and then charging you $40 every period, as opposed to the $35 million that Cisco's 1A bid was charging you. And if we ask what the loan is on this interest rate, right, what the interest rate is on this loan, we see it's 23%. The IRR to this loan is just 23%, which is much bigger than the 12% cost of capital that Wharton faces. Okay, let's summarize this. What are the lessons here? Look, internal rate of return is useful. It's a way to convey the attractiveness of a project or an investment in a manner that investors get returns. Okay. The problem with the IRR decision rule is that it only works or overlaps with NPV in certain situations when we're not comparing projects and when the cash flow signs are all negative cash flows preceding all positive cash flows. So I think the end message here is that, you know, use IRR in your project evaluation and your investment analysis, your capital budgeting. But be cognizant of the limitation. Know when to use it, know when not to use it. That's what's critical. So thank you so much for listening, and I look forward to seeing you in the next lecture, in which we're going to talk about, what are we going to talk about? Oh, the cost of capital. Bye-bye.